Welcome back to Geoscope, where we decode the forces reshaping global trade and power. Today we're tracking a tectonic shift in North America, a realignment that goes far beyond cars. For decades, Canada and the US built one of the world's most integrated industrial ecosystems, steel, engines, and entire supply chains moving seamlessly across the border. But that balance is breaking down. With US debt surging past $37 trillion and tariffs at record highs, Ottawa isn't simply absorbing the shock, it's rewriting the rulebook. The year is 2025. A fiscal time bomb, ticking for decades, finally detonates. In the summer, America's national debt surged past a staggering $37 trillion, a figure once relegated to distant worst-case scenarios. The relentless pace of post-pandemic spending, coupled with soaring interest rates, had compressed the timeline. The nation was now accumulating $1 trillion of new debt every 150 days. This wasn't just an abstract number on a government ledger, it was a fiscal straitjacket. Interest payments on the debt were on track to eclipse the entire defense budget, consuming capital and political will, leaving the nation financially exposed and desperate for a solution. Hemmed in and facing a crisis of its own making, Washington reached for a blunt instrument from a bygone era: tariffs. The move was framed as a bold act of protectionism, a way to shield American industry and claw back revenue, but the target was baffling. Not a distant rival, but Canada, America's closest ally and a partner in the continent-spanning USMCA trade pact. On August 1st, the hammer fell. A sweeping 35% duty was imposed on all Canadian imports. The administration specifically targeted the deeply integrated industries of steel, aluminum, and automobiles, sectors where supply chains are so intertwined that parts and materials crisscross the border multiple times before a single product is finished. The economic shockwave was immediate and severe. For American consumers already reeling from years of inflation, the tariffs were like pouring salt in a wound. The price of a new SUV built with Canadian steel and parts jumped by thousands of dollars overnight, leaving Detroit showrooms eerily quiet. But the pain spread far beyond the auto sector. Everything from construction materials to canned goods saw prices climb. The policy backfired spectacularly, creating chaos in the very supply chains it was meant to protect and punishing the American consumer it was supposed to serve. Instead of bringing Canada to its knees, the tariff gambit laid America's own weaknesses bare. The crushing weight of its debt meant Washington couldn't afford a prolonged economic conflict that hurt its own citizens. The policy designed to project strength had instead signaled desperation. And in Ottawa, a realization dawned. The United States was overextended, politically divided, and vulnerable. For the first time in a generation, Canada saw an opportunity to shift from a defensive crouch to an offensive stance. This self-inflicted crisis created the opening. This is the story of how a perfect storm of sovereign debt, a misguided trade war, and the immense leverage of energy resources began a seismic power shift, fundamentally redrawing the map of North America. The initial shock of the American tariffs could have been paralyzing, but rather than folding, a defiant sentiment rippled across the country, turning into a national rallying cry. It wasn't a top-down government campaign, but a grassroots movement exploding across social media with hashtags like #BuyCanadian. This patriotic consumerism tapped into a deep-seated sense of national identity, echoing historical moments when Canada had pushed back against its powerful neighbor. The Buy Canadian wave hit with surprising force. Shoppers consciously left American brands on the shelf, and cross-border shopping trips, once a weekend ritual, evaporated. The usual southward flow of traffic across the border reversed, leaving U.S. border town economies reeling. In a symbolic act of defiance, provincial liquor boards saw imports of American whiskeys and wines collapse by over 60%, as consumers rediscovered Canadian rye and local vintages. Seizing the momentum, Prime Minister Mark Carney, in office since March 2025, delivered a landmark address. From the House of Commons, he didn't just condemn the tariffs, he declared a fundamental shift. For too long, our prosperity has been contingent on the whims of a single partner, he stated resolutely. That era is over. Today we begin building a truly sovereign Canadian economy. His government's response was the Canadian Economy Act, a sweeping piece of legislation. Its first target was dismantling long-standing internal trade barriers between provinces to create a unified national market. Simultaneously, it funded a massive infrastructure overhaul, building new high-speed rail corridors and expanding port capacity on 3 coasts. The goal was a seamless internal logistics network, no longer dependent on U.S. transit routes, driving diversification into new high-tech sectors. The results came fast, leveraging existing but underutilized trade pacts. In a single year, America's share of Canadian exports dropped from 78% to 68%. In its place, trade with the European Union jumped by 20%, and exports to Pacific Rim nations grew by 30%. Mexico, in particular, emerged as a crucial partner, collaborating on integrated supply chains that could compete with and bypass the United States. This wasn't just a temporary pivot. The crisis had forced a permanent strategic realignment. Canada was no longer just reacting, it was proactively setting its own agenda. The country was forging a new identity, not as America's quiet northern neighbor but as an independent, globally connected trading nation, finally in control of its own economic destiny. Nowhere is the impact of this new trade reality clearer than in the auto sector, an industry representing a staggering 15% of Canada's exports and the very backbone of its manufacturing economy. For over half a century, the industry operated on a deeply integrated cross-border model, a legacy of the 1965 Auto Pact that effectively erased the border for car parts and finished vehicles. But the new era of trade protectionism brought this finely tuned machine to a screeching halt. The USMCA's stringent rules of origin were a direct challenge to this old model. Suddenly, automakers faced a critical choice: re-engineer their entire supply chain to meet higher North American content requirements or face punishing tariffs. The rules demanded that 75% of a vehicle's components be made in North America, a significant jump from the previous agreement. For the burgeoning electric vehicle market, the challenge was even more acute. The heart of an EV, its battery, was the primary sticking point. The global battery supply chain was, and largely remains, dominated by Asia. Everything from the raw mineral processing to the final battery cell assembly often happened outside the new trade bloc. This meant many of the most popular EV models assembled in Canada or Mexico were suddenly at risk of becoming non-compliant, effectively locked out of preferential treatment in their biggest market, the United States. But where Washington saw a problem, Ottawa saw a once-in-a-generation opportunity. In a strategic pivot, Canada began aggressively courting investment, leveraging its two greatest assets: massive federal and provincial incentives for green manufacturing, and its vast, untapped mineral wealth. Automakers like GM and Stellantis responded, announcing billions in new investments. They weren't just building assembly plants, they were building an entire ecosystem. New gigafactories were planned to produce the batteries themselves. This was Canada's mines-to-mobility strategy in action, a plan to dig up critical minerals like lithium and nickel in the Canadian Shield and process them into battery components just a few hundred kilometers away. The immediate effect for the American consumer was a price hike. Popular Canadian-built SUVs and crossovers that couldn't immediately meet the new content rules saw their sticker prices jump by an estimated $1,500 to $2,000 as tariffs were passed down the line. Yet demand in the U.S. for North American-built vehicles remained resilient. This wasn't just simple patriotism, it was also a calculated financial decision. U.S. government incentives like the revised EV tax credit heavily favored vehicles with final assembly in North America, nudging consumers to buy local. Beyond the factory floor, the very map of North American trade was being redrawn. The traditional truck-heavy corridors, like the Ambassador Bridge connecting Detroit and Windsor, began to see a strategic shift in cargo flows. To bypass potential border congestion and streamline continental logistics, shippers started looking to Canada's coastal ports. Cargo from Europe and Asia could now land in Halifax or Vancouver. From there, a revolution in rail transport took over. The landmark merger creating the Canadian Pacific Kansas City or CPKC Railway was the final piece of the puzzle. For the first time, a single seamless rail line connected Canada's ports not just to the American Midwest, but all the way to the industrial heartland of Mexico. This new iron spine of North America allowed parts and vehicles to move across 3 countries without changing carriers, creating a powerful, integrated logistics network that completely circumvented the old, congested arteries. If cars are the visible battle, oil is Canada's hidden weapon. The U.S. depends on Canadian crude more than any other source. Flow pipelines and refineries are locked into. This gave Ottawa quiet leverage. Even as rhetoric hardened, oil exports south continued and rising prices boosted Canada's revenues. Those profits are now funding pipelines, LNG terminals, and renewables, giving Canada both short-term power and long-term independence. By late 2025, the transformation is undeniable. Canada, once the junior partner in North America, is now emerging as a central economic hub. U.S. exports to Canada are shrinking, tourism patterns have reversed, and American firms are moving production north, seeking stability from unpredictable tariff whiplash. Ottawa's bold strategy, diversification, energy dominance, and new alliances with Mexico and overseas partners, has decisively reshaped the continent's balance of power. So has Canada truly taken the driver's seat in North America, or is this just a temporary detour before the US regroups? One thing is clear, the center of gravity in North American trade is shifting, and Geoscope will be here to track every turn. What do you think? Can Canada sustain this momentum, or will US pressure eventually force a rollback? Share your thoughts in the comments, and don't forget to subscribe for more global deep dives.